Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing. While top-line growth and massive headcount expansion always seem to grab the headlines, they're often just a smokescreen. The real alpha we're exploring today relies on understanding a pretty hard truth. Hidden operational debt is the true driver of systemic fragility in scaling organizations. Growth itself doesn't break companies, right? Unmanaged complexity does. So, here is our roadmap for today's explainer. First, we'll hit the VC paradox of 2026, then asymmetric information and talent verification. Third, we'll look at the climate tech supply chain edge. And finally, we'll wrap up with the repeatable flywheel framework.
Let's kick things off with part one, the VC paradox of 2026, growth versus structural reality. Okay, let's get right into the dominant narrative in venture capital right now. We call this the growth myth. It's this pervasive idea that revenue and headcount expansion inherently equal success. But if we're being clinical about it, the structural reality is completely different. You see, growth itself doesn't actually destroy enterprise value. It's the unmanaged accumulation of coordination overhead that creates what we call operational debt. Think of it exactly like technical debt, but instead of rotting away in a code base somewhere, it's choking your reporting lines, building these endless approval chains, and triggering massive misaligned execution across the board. And this debt doesn't just appear overnight. It accumulates in a highly predictable four-stage sequence. Stage one is informal coordination. This is basically pre-debt, where a small team operates with shared context, everything's fine. Then, stage two introduces emerging friction. By the time you hit stage three, you are in the danger zone of compounding debt, where execution visibly grinds to a halt. Finally, if you leave that unaddressed, you hit stage four, structural failure. The absolute crucial takeaway here for operators is that your interventions have to be stage-specific. What fixes things in stage two is absolutely not going to prevent total operational paralysis in stage four. Moving right along to part two. Asymmetric information and talent verification. This is where we get into the mathematical reality. Right at the heart of this mathematical reality is a concept we've termed the complexity coordination deficit. Simply put, this is the widening gap between what an organization's structure actually demands, its coordination cost, and what it can legitimately deliver, its coordination capacity. It boils down to a fundamental law of organizational design. Coordination capacity scales linearly with your investment in management and tools, but coordination cost, that grows combinatorially. To put that into perspective, just think about this number, 499,500. If you have a 10-person team, you're managing just 45 connections. Easy enough, right? But scale that to a 1,000-person company using basic network math, n times n minus 1 divided by 2, you suddenly generate nearly 500,000 unique potential points of friction. At that scale, direct coordination literally becomes mathematically impossible. And this is exactly where the architecture has to change. When you deploy agent capital, what we refer to clinically as KA, coordination cost actually falls hyperbolically. At the exact same time, managerial span of control can expand linearly. So agentic AI isn't just about making individual employees type faster or code faster. It structurally compresses the fundamental friction of the entire organization. It effectively allows a single decision maker to coordinate a vastly larger surface area without the system collapsing. Which brings us to part three, the climate tech supply chain edge, and how we actually go about measuring this hidden operational debt. Elite cross-border operators absolutely do not wait for structural failure to suddenly show up on an income statement. Standard diligence processes, they completely miss systemic coordination failures because they're hyper-focused on lagging financial indicators. Honestly, if you're waiting around to see margin compression or customer churn, you are already years too late. Think about it. Margin compression is usually just the financial symptom of high rework rates. Customer churn, that's the ultimate result of internal decision latency. And executive attrition almost always stems from span of control drift. When we map these lagging financial symptoms back to leading operational indicators, we finally uncover the true structural causes. Spot on. And to actually get ahead of this, you have to track these four proprietary leading indicators. First up is decision latency. That's simply the time between a required decision and its actual execution. Next is coordination load per employee, meaning the sheer volume of calendar time eaten up by alignment rather than actual output. Third, we look at the rework and reconciliation rate, which is the percentage of your output that requires correction just because of misaligned context.
And finally, span of control drift. This happens when managers end up absorbing more direct reports without any proportional increase in their coordination capacity. Put these together, and you've built a highly sensitive, data-driven early warning system for your organizational infrastructure. Finally, let's dive into part 4, the repeatable flywheel framework. This is essentially the operator's playbook. Now, this playbook strictly avoids your typical empty management cliches. We are talking about pure institutional structural redesign here. Step 1. Compress your decision architecture relative to size. You have to push decision rights down to the people who are actually closest to the information. Step 2. Treat coordination capacity as a strictly budgeted resource. Cap those meeting loads and strictly limit cross-functional dependencies. Step 3. Clearly separate centralized governance from distributed execution. And Step 4. Instrument your organization to monitor decision latency with the exact same rigor that you apply to your revenue metrics. And arguably, the most powerful lever in this entire playbook is understanding the fundamental difference between execution load, which is directly producing work or deliverables, and coordination load. Coordination load is all that status synthesis, context transfer, and exception routing that bogs everyone down. The true institutional value of AI isn't just about doing the execution work faster, it's about deploying agentic systems specifically against that coordination load. By absorbing the administrative friction that naturally scales with hypergrowth, you effectively free up human judgment for the critical, high-leverage decisions. That is what actually drives alpha. So the ultimate question you have to be asking about your portfolio right now is this. Are your coordination costs quietly outrunning your operational capacity? Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.